Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted today to have with me David Buik, City Grandee, an expert on all things markets related at Aquis Exchange. Morning, David.
Morning to you, Paul, and not true, but lovely to chat to you.
Given the NASDAQ is hitting sort of all-time highs, and we've had this really strong equity rebound since its March 23rd lows, and you then compare that to the sort of the economy and the high unemployment levels, I sometimes wonder whether I've entered Alice in Wonderland. What are your views on the broad sort of markets at the moment, and how do you see them shaping up going forward?
I think I'd have used the analogy of Rumpelstiltskin, but it'll do. I'm completely perplexed, but when you actually strip out the top six in the NASDAQ in terms of performers, you know, whether it's Amazon, Apple, Microsoft, Zoom, Netflix, and people of that nature, then you probably understand why they've done so incredibly well during this awful period of lockdown. They've delivered everything that everybody's needed at home. And the fact is that it's appalling to think that in the case of Microsoft, Amazon, and Apple, that if you add together their capital value, their capital share value, it's twice the size of the FTSE 100, which is amazing. They are three of the greatest companies in the world currently at the moment. And nobody's got any answer to them anywhere else in the world. And I think that's the reason why we've seen the NASDAQ bounce up. You strip away from the top 5 or 6, and the NASDAQ's performance, it's not all that wonderful. And they have driven it. And my word, when you get gains of 50% and 299% in the case of Zoom and the rest of it, it's hardly really surprising. But to answer your question more fully, I am absolutely perplexed. I could understand the 25 to 30% drop from the 12th of February. The market was years ahead of the World Health Organization, and I couldn't understand why. But what I haven't been able to really follow is the incredible rally since the 23rd of March, because the data is horrendous. The COVID-19 is not under control. Unemployment is going to be rampant everywhere in the world. Now, we have lived in the past with a buoyant stock market with very big unemployment, but these conditions are completely different. And I'm not sure whether the expectation on these PE ratios going forward are justified. Time alone will tell. We've had the bulls knocking 7 bails out of those people who provided the medical and scientific data. They just don't want to believe it. They believe that the recovery process is in place, and they think that a vaccine's nearly there. I mean, it was interesting to note this morning that Moderna was up 18% at $88 before the markets even opened. And also Dr. Sarah Campbell at Cambridge, it seems pretty certain, at Oxford, seems pretty certain that she's got something pretty exciting which she's going to develop with AstraZeneca. So
do you think the markets, David, do you think the markets have actually priced in success on a vaccine and therapeutics this year? And what they're saying is such that the huge amount of government and central bank stimulus we've had, which is roughly around about 15% of global GDP. I mean, if you look at it optically wise, this year, the UK, if it decreases GDP by 10% and the US by 10%, then filling it with a whole bunch of helicopter money from the central banks of 10 to 15% will make that void. And therefore, I think are the markets sort of like positioning themselves that they're saying the governments are buying themselves time, but hoping and praying that we're going to get a medical solution?
I think that's it, because otherwise we're in make-believe land, because the service sector in so many countries, particularly the UK, is unbelievably important. And, you know, the fear that still prevails is acrid. And people are not, you know, getting hold of the bit, to use a horse racing expression, and getting out there and spending money in the shops and the rest of it. Yes, the online stuff's doing fine. Yeah. But that's not going to help.
It's quite interesting, actually. The Financial Times came out with who the consumers are actually spending their money in, because what we've had, as you probably know, over the last sort of 2 months, is that the savings rates across the Western world, because most people in their house haven't been able to actually spend any money, is rocketed by about 8 to 10%. And what they have been spending the money in is the home, DIY, and the garden. But the restaurants, leisure sectors haven't recovered. How do you, when you build that in, and there's obviously a lot of pent-up demand because people want to go out, and let's just assume we do get a medical solution just for this moment, how would you see the sort of the economic recovery? What kind of sort of like, you know, letter of the alphabet would you? Is it a V, U, W? I know that's, nobody's going to hold you to it because nobody knows, but it's obviously the market's very, very bullish on it. But the sort of the likelihood of that transpiring, what are your thoughts?
I'm reluctant to say that I think it's a U, as far as I'm personally concerned. I mean, there are signs of a recovery, but everybody talked, gosh, you know, all the PMIs and the ISM manufacturers, non-manufacturers have shown great spikes in the course of the last 6 weeks. Of course they have, from absolutely the depths of despair. But that doesn't mean the market is, in my opinion, going to select another gear in terms of realizing what we priced in as being, you know, optimistic more than anything other than optimistic. I don't think it's realistic at all. Yeah. I mean, gracious me, I hope I'm wrong. But when you consider the level of debt that is going to have to be written and has already been written for the last 6 months and what's going to happen for the next 2 years, somebody's got to pay for that somewhere down the line. I'm a great believer that we will recover. I think the human nature is such that people are unbelievably resilient. But I don't see the service sector, which is so important, not only here, but also in the United States, unbelievably important. And when
just on that, we had the data point yesterday. What are your thoughts on the key US banks, the JP Morgan, Citigroup, and Wells said yesterday with their, I think they put sort of like $28 billion of extra provisioning. And what were your thoughts on the sort of like their outlook and any read across to the U shape you're thinking of?
Well, if you strip out, I mean, the person I listen to more than anybody else, I can't believe you're wholly different, is Jamie Dimon, the chief executive of JP Morgan, who, you know, was pretty, not scathing, but he was very worried about the future, as he pretty much said so. I mean, they are always incredibly light on their feet, JP Morgan, and they've had an outstanding quarter trading. And that has been the case, of course, for Citigroup as well. And they've had an outstanding trading period during the last 3 months. Now, you look at Wells Fargo. Now, Wells Fargo's provisions for bad debt were 8.4 billion, if my memory serves me right, against JP Morgan's, which was far bigger than Citibank's, which was at 8.9 billion. But no disrespect to Wells Fargo, but it's a Mickey Mouse operation in comparison to JP Morgan. So that is a fearful figure. And one of the reasons why the market took Wells Fargo's price down by about 5% yesterday. I mean, Wells have not had a good run at it for the last 2 or 3 years. And I think if I'm going to sense of what's happening in the real world, I'm going to be listening much more to Wells Fargo, not because it's not a particularly well-run bank, but it's rather like the Lloyd's Bank of the United States of America. Unimaginative, virtually no investment banking, just mortgages and just retail banking and business banking. Now, we're going to hear from Goldman today. And Goldman, I would imagine, will see its trading has done incredibly well. One of the things I don't think it probably may not have done that well is the question of what you and I would describe as M&A activity and business development, because obviously there were some deals around, but nothing like what there were last year or the year before. And I'm also of this opinion, I don't know whether you agree with me or not, but there's just a classic chance of each country being able to look after its own. Like I would like to see the broking fraternity in London get a hold of the bid and really do the number for the capital raising that's going to happen after many of these companies have been trashed over the period of the last 6 months. Why should Goldman's own it? Why should JP Morgan own it? Why should Deutsche Bank and UBS? We have very, very good financial engineers in this country, British, and the same would apply for any other country in the world to do the same thing. Also, I think financial advisors in terms of PR companies, they're not just doing PR anymore. They've got some really smart brains.
I guess it comes down to the appetite, though, for investors, because the US has been very much a sort of like entrepreneurial society, whereas the UK is more patient and more reticent to put its money to. And it's a sort of that, if the availability of capital's there, then that's fine. But I think a lot of the time when you're looking at big FTSE companies and they have international footprints, then they need international investors to be able to support any fundraising. So I think restricting the number of investors, I would agree you could use it as advisors, as like maybe it's locally, but if you want access to global investors, then you need, international outlook.
I agree, but I was more thinking of, where our real future lies, Paul, is, in my opinion, many more really well-run AIM companies coming to the market, and also the smaller of the FTSE 250s. Your comment on the FTSE 100 and the top end of the 250 is taken as read, and you are 100% right.
Yeah. I did notice actually on the JP Morgan comments that the CFO, when he put his provisioning up from last quarter, he did say that he was expecting unemployment in the US to be above 10%, which is much higher than what the Fed predicted 2 months ago, which was about 9%. I don't know whether you got the feeling, is that realistic, or whether they're kitchen sinking? I mean, I did think if you put all the provisioning together at $28 billion, it seemed a very heavy number, and I could actually see what happened at the great financial crisis. They started writing back these provisions about a year later. It all depends, really, if we get a medical solution. And I think, as you're using your analogy about horse racing, then we'll be off to the races, you know. But the longer we don't get it, and that's why I was so encouraged overnight with Moderna in their phase 2 trials, because they were
I agree with you. Sorry, Paul, I interrupted. Sorry.
That's okay, because I think with 45 patients, all 45 responding positively and without a safety impact, then that was very encouraging. So I guess, anything else? Any thoughts on that at all?
Yeah, no, I mean, I would endorse all your sentiments there. The only other thing is that there doesn't seem to have been an awful lot done yet, but you're going to need some innovative thinking, because people are going to have to start thinking left field. There's no question that in this country alone, 2 million people, once that furloughing is finished at the end of October, ain't going to get any employment. And many finance directors are going to be looking around saying, whew, had a chance to lighten up. I don't need so many people. This is the way business is at the moment. We're changing the way we run things. I mean, office space, for instance, I wouldn't be particularly bullish of commercial property companies now, because when the leases are up, people are going to say, we don't need everybody in the office at the same time. You know what? I'm going to take a quarter of the square footage I've got in the City of London or in the West End. I'm going to open an office in Woking, and it's near the M25 or the Gatwick and Heathrow. That's the way forward. And it same applies Manchester, Leeds, Birmingham, the rest of it. We're changing. And this is where I hope that people have got to be and been given the opportunities to retrain in areas where they can give something to society. Because you worked in XYZ company making, Wisbeach and things in Wisbeach, that doesn't give you the divine right to think that you're going to find a similar job elsewhere, because you're almost certainly not.
Yeah.
I mean, what I was thinking was, this is, I think, absolutely fundamental.
Yeah, no, I agree wholeheartedly. And I think a lot of it, I mean, given if we're not traveling as much and we're not having to travel to work as much, the productivity in theory should go up. And I think we probably just need a more flexible workforce whereby people can do sort of multiple jobs. And you might find during this transitionary period that whereby people are having to stay at home because they're ill or whatever, we have more people being able to pick up sort of the slack and slot into those availabilities. But we'll wait and see, I guess. What sort of what sort of other downsides you see in the market? What risks, say, associated with the Trump the presidential elections? I mean, I did notice the bookies are saying that Joe Biden is an absolute sort of like shoo-in for Washington at the moment.
Well, last time I looked, it was Biden 52%, Trump 40%, and 8% undecided.
Oh, okay.
So that looks pretty strong to me. My big worry, to be perfectly honest with you, is this deal that has been done or withdrawn from Huawei. I hope and pray that Prime Minister Johnson has agreed a trade deal that can be completed before November with President Trump. If he hasn't been able to do it with Ross and Mnuchin and others, I think that the UK is going to find itself pretty vulnerable.
Why is that a worry? Yeah, why is that a worry?
Well, because I've been told, whether it's right or wrong, that if Biden and the Democrats form the next administration, hell's got a better chance of freezing over than the Democrats agreeing a quick trade deal with the UK.
That is an excellent point.
And it is a concern to me, because if you've said, yeah, security is really important to me, and it should be, and yeah, I don't mind writing off $2 billion of extra costs in order to get the right deal. Maybe I'm 3 years behind the time. I don't particularly like that, because I doubt there have been too many contingency plans. But just to say to China, ta-da, woof, that's a big call. if you haven't got something else in your left hand saying, I've got a pretty good.
Oh no, you're right. That hadn't occurred to me. It's an absolute. I think that's a real sort of risk to particularly to UK investors, because if Trump loses, then Boris Johnson's big friend out in the States disappears. Then it becomes an automatic enemy, doesn't it, of the US? Not sort of like openly, but certainly subconsciously.
No. I mean, if you listen to Nancy Pelosi, I mean, she's made it crystal clear that there is no way, while she's in control of Congress and the Democrats have got the overriding word, that it's going to happen. And so maybe there's more to this than meets the eye. If it doesn't, then I think we've got a serious problem. I mean, out of Europe, that's one thing. I don't want to discuss the pros and cons of that because it's done and dusted, and we are.
So how would you protect yourself if you had a portfolio, so with investors? I mean, I protect myself really through equities and cash, and I'm a long-term investor, and I'm prepared to hold through the ups and downs, and therefore I don't use sort of like derivatives. But there was a massive, very strong correlation between equities, bonds, and gold, and everything asset-related in March, and likewise the Great Financial Crisis. How would you suggest that people might consider sort of like protecting their portfolio to these risks?
Well, I mean, part of the usual old, horny old instruments such as futures and spread betting, which I think is not really active for very big players.
Agreed.
I think what has to happen now is that you've got to get your countries right, and you've got to get your stock picking right. And the idea to look at any indices or country just based on you think it's got a long-term future or a short-term future is probably folly. I mean, myself, the strong economies in the world in the United States, I am worried that this COVID-19 has trashed the United States rather more than people think, away from what we described as the big tech sector. I think going forward, people will start to look at Japan. I thought Japan was on a tremendous roll. Wonderful World Cup. The regulation, which was a disgrace before, I worked there for 2 years, so I know a little bit about it. And the fact that it was so incestuous that every bank and company was invested in each other, that's all tidied up. Then they had the Olympics, and I thought, ooh, the Nikkei's rock and roll territory. Well, we've had a setback. But I think over 5 years, Japan is a country that I would be more than interested in looking at. And emerging markets, I think I'd take away my emphasis. I'm not a bull of Europe or the United Kingdom. Yeah. The FTSE companies, if they're international, whether they're the Diageos or these sort of people, and they've got dollar earnings and currency earnings elsewhere, great. But to be supporting, I think specifically German, French, or English companies, British companies, outside of what I call the international ones. I mean, I love these Sanofi Aventis, the Roches, the Novartis, the AstraZenecas, all these guys, top people. Diageo is a company that I've always respected and liked. Oil companies, I think you have to be very careful of because of what's happened to oil and the recovery process. Maybe it is the right time to climb on board, but I need to see more from the new managements, the Bernard Looney's and the others and the Ben Van Burens before I climb on board. And that's what I think is that I think you've got to focus Europe on international companies and not domestic-based ones.
Brilliant. Well, thanks very much, David. I mean, I've gone from the sort of like the Alice in Wonderland to going Japanese, so that's probably a good way to finish. And again, thanks for your insight. It's been really helpful, and look forward again to speaking to you soon.
Look forward to it. Thanks so much, Paul. Really enjoyed it.